Good morning, everyone. Thank you for taking out time on a Sunday morning. Uh, this is the next webinar of MeritorQ Advisory offering on small case. The agenda for today's webinar is to understand quant investing in general. Quant investing is also referred to as factor-based investing, rules-based investing, or algo-driven strategy. There are a few other names as well. Now, by definition, quant or quantitative investment strategies use mathematical models and algorithms to identify investment opportunities based on certain data points in time. These strategies are purely systematic and remove much of the emotional element, or as we call it, human bias from investing. Today, Krishnan, who heads the quant research function at Marcellus, will help us deep dive into some of these data points, systems, and biases. We will also touch upon the approach we have taken in MeritorQ. Uh, MeritorQ is basically the quant investment offering from the house of Marcellus, and how it is different versus the discretionary style of investing that we are all familiar with. Post this, we will have the Q&A session. Please feel free to type in your questions into the box on your screen. Now, without much delay, let me start by asking Krishnan about what is the difference between quant and the discretionary style of investing. Hi, Krishnan. Please share your views on the difference between quant and discretionary style of investing.
Thanks, Alok, and a really good morning to all of you who have joined us on this session. I hope again we can have a fruitful discussion on this topic which we're discussing today. So I'll just share my my deck, right, which kind of explains what Alok you just mentioned. I hope it is visible. Okay, so just put this on slideshow. Then also in a minute. Yes. So before we proceed, just note that anything and everything that you will discuss today, again, these are again the figures presented. They are for illustration only, illustration and understanding only, and do not guarantee any future returns. And investment in securities are subject to market risk, and you should read all scheme-related documents before investing. Now, coming to your question, Alok. So over the years, two main approaches are evolved in active management, right? So one is what is called as quant or systematic. Other is discretionary. When you say discretionary, essentially it's a human fund manager who is or a human advisor who is taking call on how the portfolio should be constructed, what stock should be chosen, and what allocation should be assigned to those stocks, right? So when you think about systematic, though, right? Systematic is essentially you're following a repeatable data-driven approach, right? And it relies basically on computers, a programmatic approach to identify investment opportunities across many securities, right? So you decide on the rules, right? And you validate those rules. And if you think those rules would have generated money or would have earned good risk-adjusted returns in the past, you take those rules and to build the portfolio as such, right? So that's the systematic or the quant approach, right? A discretionary approach or the normal approach, I think a lot of viewers would be used to basically involves either the fund manager, advisor, or their team doing the in-depth analysis across a small number of securities. And essentially, this also involves information which is not easily quantified, also, right? So whereas again, quant strategies, again, they are using information. Remember, right? So either it's fundamental information or price information or either any kind of alternative data. They are basically using quantifiable information to take calls, right? Whereas when a discretionary style of investing, you're relying on all this, but also you might also rely on things which are not easily quantifiable. For example, quality of the management, right, or the character of the promoters, right? So again, that's kind of like the broad difference. Systematic investing, it requires a longer data history because again, like I said, right, rules can only be decided only if you're able to validate those rules, right? And to validate those rules, you need to have enough history, in the sense that, for example, if you are planning to invest in large caps, you should have at least 10 years worth of history for you to validate and say that, a particular rule will work across market cycles, right? And also the market also needs to be liquid, right? Because otherwise, a lot of assumptions you are making in terms of how profitable the strategy is, it might not actually be realizable, right? Think about microcaps in India. So beyond the top 500 or 1,000 companies, it's it's easy to say that you'll generate a lot of returns, but actually when you go and invest in these stocks, you'll find that there is nearly negligible liquidity. So if you're not not able to manage money, that to a good amount of AUM, investing in this strategy, obviously, whatever you've tested, using, your own methodology, etc., that might not actually give you the same returns going forward. A very important point is quant strategies are very different from passive investing. So this is a one question we usually get, because quant strategies are basically an active call, right? So basically, you're taking active calls on which securities will do well going forward, and you're depending on the style you have chosen, or the strategy you have chosen. You're basically either including those stocks and getting rid of unwanted stocks, right? And obviously, you're also position sizing basis the views, right? Your proprietary views on what might work or what might not work going forward. Passive investors don't take this kind of a call at all. So essentially, for passive investing requires nearly, so they include the entire market, right? In most cases. So for example, if you're investing in a large cap ETFs, you are basically, it would be tracking an index, a large cap index, which would be including all large cap stocks in India, basically the top 100 stocks, and it will be weighting those stocks per their market cap, right? So you're not taking calls either on which security to include, exclude. Neither are you taking a call on the weighting, which is market cap weighting, right? Whereas, systematic strategies will do both, right? So they will take a call on, security selection as well as position sizing. So, and both these are expected to give you alpha, right? So again, if you think about active management, right, one of the most important objective of active management is to generate alpha after fees, right? It should be a value add to the investors after fees, and this is what systematic strategies also try to do. Similar to what any other discretionary strategies will attempt to do, right? So again, just to draw that distinction, right? Because when we discuss quant or even systematic strategies to investors, generally the question we get is how and why these quant as such is different from passive investing. So when you think about MeritorQ, right? Again, this is one area which again people are not very clear about. So again, just to recall, right? So again, when you see this funnel chart on your left on this slide, what we have is all the different steps. We have gone through these steps before, but just to rewind a bit, we start with the top 500 companies, which is your large, mid, and small cap companies in India. And then we apply three screens, right? Essentially filtering steps. The first is, forensics. Second is, removing companies with high debt. And third is companies, which have inconsistent profitability, right? So after we apply these three steps, we are left with around 80 to 100 stocks, and we select undervalued and profitable companies, right? Now, if you think about each of these steps, we are focusing on fundamentals, right? If you think about, when I say leverage or, companies taking too much debt, we're looking at, say, the debt to equity or, their company's ability to pay back, the loans they have taken from bank, right? Similarly, when you think about consistent profitability, again, we are looking at things like return on capital employed, how consistent it has been for that company, over the last, whatever years, right? 3 or 5 years. Similarly, when you're saying about forensics, right? We have explained this in the past. So our forensics, filter is, something I would say very unique to Marcellus, where we look for essentially companies with clean accounts. Essentially, we are looking for companies, who are presenting their financial statements, in an objective way, and they're not cooking their financial statements. So essentially, we are looking at a number of ratios to do this. For non-financials, we look at 10 ratios. For financials, we look at another 10 ratios, different set of 10 ratios. So again, the purpose there is, again, we are looking at a company's fundamentals, right? To say whether these companies are either clean or they are not taking a lot of debt, or they have consistent profitability or not, right? So the key aspect I want to highlight is even though MeritorQ is systematic, right, we are following these rules in a very disciplined way. Again, I'll touch upon some of the other aspects, but we follow these rules in exactly the same sequence at every rebalance. The key difference is we are looking at the fundamentals, remember, right? So there is we're not looking at things like the price trend of these stocks or the momentum of these stocks, whatnot. Even though some of the other strategies, quant strategies might be looking at these. So we are looking only at fundamentals. So when you think about quant and discretionary, many people would like to suggest that maybe these are at two ends of the spectrum. But even that I would say, when I will see that when we see the next slide, I would not agree with that. But quant and fundamental, or systematic and fundamental, need not be completely be uh, mutually exclusive, right? So it is possible for systematic strategies to look at fundamentals also, which is what we are doing in MeritorQ. So moving on, now we have again noted this division of active managers into two categories, right? Systematic and discretionary. While there are certainly differences, between the two approaches, there are also similarities, right? And in fact, there is potential overlap between the two. In particular, there may be similarities in the kind of characteristics a manager might be looking for when they are investing in securities. In general, fundamental discretionary managers tend to look for companies that trade for less than what they are worth, right? Essentially, you're looking to buy good companies which are available at throwaway prices, or sasta mil raha hai. So if you think about a systematic model, right, it can do exactly the same thing, right? You can look for cheap companies using a model, again the way we are doing, right, where we are looking at companies which are cheap relative to their free cash flow generation. This is the free cash flow yield. Similarly, a discretionary manager could be looking for companies not only which are cheap, but which are which have resilient business models, right? Or which might have a future event or a catalyst which might prompt again a change in this valuation or this undervaluation, or the company corrects its undervaluation, and it reverts back to its fair value. So if you think about what a systematic manager might be looking at is analog for this would be momentum, right? So you're looking at undervalued companies, you're looking at cheap companies, which the systematic manager is also looking for, but you're also looking for things like momentum, or you're looking for, and if you think about discretionary managers, they might say, I'm looking at, a resilient business model, right? Or a quality business. What the systematic manager might say is, I might be looking at companies with, consistent profitability, right? Like what we are doing, right? Or they might say, I might be looking at companies with low volatility, right? Or defensive stocks, right? So again, the key difference here is, when you think about it, it looks different on the surface, right? But actually the end or the outcome is, identical, right? And obviously there are other ways now, especially on the when you look at systematic strategies, given the availability of data, given the availability of technology, where you can quantify management intent also, and also how what management might be implying when they for example say something in for example an earnings call, right, or during a management commentary. You can do a textual analysis of the earnings transcript, right? Or you could look at, for example, insider trades. You could be looking at the changes in the corporate policy, so on and so forth, right? So all I'm saying is, what the themes which the discretionary manager is looking at, that is possible for a systematic advisor or a systematic strategy to capture all those. The only difference is in terms of the terms, right? The lexicon. So this is what we have shown on this slide. So when you say cheap on a fund, when a fundamental manager says cheap, the systematic factor we are looking at is value, right? When you're saying cheap with some catalyst, you're looking at value and momentum, right? And so on and so forth, right? If you go compare these columns across all these different metrics, you'll probably get a gist of again what we are trying to say. So and again, the other thing is, and we have emphasized this before in MeritorQ, the systematic approach we have taken is again because it's fundamental focus. The other thing is, we are focusing on things which we think should be part of or rules which should be reasonable, right? In other words, they should have economic rationale, right? So when we say, for example, we are removing companies with high debt, we have seen that in the past what happens to companies in India, right? Which if they carry too much debt or which take too much loans from banks, right? Again, you can see NCLT cases, multiple NCLT cases, defaults, whatnot. So taking too much debt is never a good thing. And again, if you think about that rule, essentially we are trying to avoid risk from such companies which take too much debt and endanger their shareholders in the process, right? And while historical experience or the back test, right, or the model portfolio which we create, the performance of that is obviously an important input in deciding what works and what not, or what doesn't work. For us, it's also important to make sure that all these rules make sense from a rational perspective, and they can be they have good sound or justification. So again, look at fundamentals, and we are making sure that all of this is backed with good justification as such, right? Now, the last point maybe, because generally what you find is systematic strategies are data driven, and they follow a data driven repeatable process. It is more efficient for them to increase the breadth or the number of securities over which they're doing the analysis, right? And a larger breadth is basically, it means that a large investment universe, right? So which, in fact, if you think about it, for a discretionary manager is a handicap, right? So because he has to, hire a lot more analysts to analyze all these securities, right? It is not a problem for a quant strategy or a systematic strategy, because once you have built the rules, right, and once the process is set, you basically have to repeat this, and you can do this over 10 stocks, you can do it over 100 stocks, you can also do it over 1,000 stocks, right? And in fact, you can do it repeatedly as much as possible. uh, uh, Obviously, that leads to churn, but you can do it more often than, for example, a discretionary manager, right? Because it's the whole process is more efficient, it's programmatic. Now, obviously, we do know that this is not so black and white. Discretionary managers, obviously, they have their own edges. Even though they're handicapped by the size of the investment universe, they might, for example, like I said, right, be able to use information which is not quantifiable, and also be able to appropriately size their position, right, based on the conviction of their ideas, and be more adaptive, right? Whereas if you think about it, the quant strategies, we are talking about, these rules, you might not have that flexibility to, change your position sizing or your style depending on the market conditions, right? So we'll touch upon this, later on. But again, just to, give that small allowance, right, which discretionary managers also enjoy with respect to quant strategies. Now, coming to this, this issue of breadth, right? In fact, just a passing comment. So, there is in fact a well-known relationship between a relative risk-adjusted return and the skill or the skill of the fund manager, and which basically relates your relative risk-adjusted return to the skill of the fund manager and the breadth of your investment universe or the number of stocks you're analyzing, right? In fact, this relationship is skill into square root of breadth, right? So if you're uh, so essentially breadth, you can think of the independent bets you're taking. And if your independent bets in a year go up by 4 times, so if you're rebalancing, say, 4 times instead of 2 times, and you're also doubling your portfolio, so what that means is your risk adjusted return will go up by 2. It will double almost, right? So that tells you, how important it is, for again, for having a large enough investment universe to analyze. And even if you don't have enough skill, in fact, for example, you have information which you can't completely quantify, as systematic managers generally encounter. So again, your skill is not that much. still having that breadth, right? What that ensures is your overall risk-adjusted return is still comparable to a discretionary manager, right? Now, coming to this, what we have discussed in the previous slide, Quant has an advantage over discretionary investing. Obviously, we have seen when analyzing a large investment universe in an unbiased fashion. Now, a large investment universe, again, just drawing that intuition, right? Again, from any other fields, we can also call this a sample size in statistics. And it's a very important factor, right, which influences the meaningfulness of statistical outcomes, right? And you would have probably seen, for example, the margin of error in, which many surveys report. So, elections are around the corner. You would generally, surveys or exit polls would be conducted. You would generally have all these survey poll results, with coming with, some margin of error, right? Now that margin of error, in fact, depends on the sample size, right? And the larger your sample size, it's lower is your margin of error. So again, that tells us that again, a large sample size or large investment universe, right? If you think about what we are doing here in MeritorQ, again, it has the same implication, right? So essentially, what this means in MeritorQ is when you're looking at these 500 companies, right? Because we are following a systematic approach, we can analyze these 500 companies, efficiently, and repeatedly, right, and in a consistent way. And because you are analyzing and ranking stocks, again over such a large investment universe, what that means is these rankings or these this filtering, etc., wherever we are doing these rankings, relative comparisons, all of them become more meaningful because a large investment universe, like I said, right, is a better separation among companies on these different metrics, right, which we discussed. And this in turn magnifies the power and the reliability of all the steps, right? So, maybe a close enough example would be, for example, if you think about, if you're trying to find the best engineer in India, right, or best set of engineers in India, what would be your criteria? Would you look at, for example, the ranking of a person in one college, or would you rather look at the ranking in, for example, a national level exam like IIT joint entrance, right? In IIT, for example, we know that more than 3 lakh, 4 lakh candidates appear for these exams. So the ranking of someone in in such an exam, in such an entrance exam, makes the ranking itself more meaningful. And that's again the power of the sample size, which helps you separate the wheat from the chaff, or the good quality engineers from the not so good quality engineers. In our case, essentially this large investment universe in the same way helps us to improve the power of our filtering steps and our selection step, and separate between companies which will give us good risk adjusted return, and excluding the ones which will distract us. So I hope I was able to explain. Again, long explanation for your question, but over to you.
Yeah. Yes, Krishnan. So this was pretty insightful, detailed answer to my question. This helps clear a lot of doubts that some of us have around a difference between a quant strategy and a general discretionary strategy. The next question that I have is, so in this current world, we are constantly bombarded with opinions and news flows. It can be via news channels, social media, through financial influencers. Now, these news flow influences us to take unnecessary, or as I call it, bad investment decisions. We keep hearing good things about, say, XYZ company on a daily basis, and we start to believe that the said company is amazing. And if we do not act now, we will miss the bus. So instead of thinking rationally and studying the company basis the available data, we end up probably buying a wrong set of companies at a wrong price. Right. So do you think a systematic investment approach can help us mitigate some of these risks, which we also call it biases?
Absolutely. And in fact, this is one of the biggest, I would say, one of the biggest advantage of a quant or a rules-based or a systematic strategy. And maybe just to touch upon this in a bit more detail, right? So when you think about biases, biases are nothing but again uh, you know very specific to human behavior, right? Because it's related to what we are kind of used to, or we are conditioned to, right? And again, you can, there are different ways you can call these biases. One way is, many people call this as mental shortcuts, right? Human beings are used to when making decisions. So even those set of rules, or that those heuristics might work in certain situations, they don't work in all situations, right? um, and in fact, there is a separate field called behavioral finance, which again analyzes how human beings handle financial decisions. And it kind of says that the investors in most cases do not analyze all the opportunities. Either they don't look at all the possibilities, or they're not looking at how they can absorb or clinically analyze all the relevant information which is there, right? um, Again, this is again, behavioral finance is different from traditional finance, right? Traditional finance, people assume that everyone is rational, we take decisions rationally, but this is not true in most cases. So if you think about biases, we have highlighted a lot of biases, by the way. Human biases, we have highlighted some of the biases in this slide. Hindsight biases, just being looking back at an incident, saying that, hey, I knew that, right, that is going to happen. Similarly, loss aversion is being more sensitive to losses rather than gains, right? And recency is you're looking at the most recent events and taking your decisions rather than the full history, right? So you're overweighting the past, the immediate past, rather than the the wealth of history which is available before that. So in fact, what I'll do is, at least for today, we'll focus on one of these biases. It's called availability. Availability bias is, refers to a human tendency to use only readily available information, right, to make decisions and ignore what's hard to find, or but in fact could actually be more relevant, right? So you're basically looking at or focusing on information, which is available on, say, media, which is available from, say, analyst reports, whatnot, but you basically ignore information which is not easily available, even though, again, which is it could be actually be more relevant, right? So again, this leads to attributing this leads to investors attributing higher frequency to events on which information is easily available than which is not, right? For example, I think this is a for me, this is a very an easy test, right, generally, and I find it quite amusing when I talk to people, just to figure out, and make this point on availability bias. So uh, uh, let me ask you a simple question, right? In India, how many people do you think die from road accidents versus tuberculosis, right? So again, the question is, in which case do you think more people die in India every year? So usually what happens is, when I ask this question to people, uh, you know, uh, generally most of the audience will tell you, majority will tell you that, more people in India die out of road accidents, right? Uh, Whereas if you actually go and check the statistics, right, of people dying from tuberculosis or and road accidents, if you compare it, in fact, twice as many people on an average die uh, from tuberculosis versus road accidents. And one of the reasons you could attribute this to is because road accidents, generally, road accident cases, or road rage cases, you can find, third or fourth page of your newspapers every now and then, whereas tuberculosis deaths are hardly reported, right? So you might hear about, for example, nowadays about COVID deaths or whatnot, but people will hardly talk about tuberculosis, which is kind of like a silent killer in India, at least, right? So this again is just to make that point, right, on what is relevant versus what is available, the information which is available, right? In investing, availability bias manifests almost daily in the overreaction, for example, to market news, right? Market news is the news which is flashing on the headlines. An investor might react negatively to news, for example, of a product recall by a company, when in fact a product recall might not even have a large financial impact on the company, right? On the flip side, the company which is rather, think about a company which is rather tight-lipped, but fundamentally sound. There are a lot of examples of these companies, right? Some companies don't do quarterly earnings calls, for example. They'll just do annual earnings calls, right? So not much information comes out of these companies, right, regularly. Whereas you might think about another company which keeps on generating news flow, but that the first company could actually be much better investment versus the second company, right? And this is an area where systematic investing again has an edge, right? So coming back to your point, right, whether systematic investing can help us overcome biases. Systematic investing, again, remember, we are a human fund manager is not making these calls, so there is no question of any of these biases getting into your investment process, right? So, and because once the rules are set, you're just following these rules day in and day out. You don't have to worry about, for example, separating out what is the news flow versus what is relevant, right? So at least this part is taken care of. And coming to, again, maybe one more additional point, right, on how this makes sense for MeritorQ. In fact, when we went back, we looked at the MeritorQ model portfolio. And what that tells us is, the allocation towards, we looked at the allocation of companies with respect to analyst coverage, right? So analyst coverage, if you think about it, if you could be one barometer of information availability, right? So more sell side analysts cover a particular company, the more you can say it is well followed, right? Or that company is well followed, and more information is available about that company generally in the market, right? So we went back in our model portfolio and we looked at what is the percentage allocation to in MeritorQ historically, right? And this we looked at over the last 16 years from July 2006 to September 2022. What's been the historical allocation to such companies in the model portfolio? And we found out that average is around 13%, right? It might not look very meaningful, but let me tell you, this 13% has a much better risk-adjusted return, right? At least in the history versus the cohort, which is, or the rest 87%, which has a good analyst coverage, right? So just to give you some examples of specific companies, we had, for example, a leisure wear and undergarment maker, Page Industries, which has been part of this this model portfolio since 2012. So Page Industries first entered MeritorQ model portfolio in 2012 when it had a market cap of 2,700 crores, right? Today its market cap is around 40,000 crores plus, right? And at that point in time, 2012 or 2011, if you go back and check, right, the analyst coverage was pretty negligible, right? It was not so well known on the street, right? Another example is the tiles and faucet maker Serra Sanitary Ware. Again, this entered our model portfolio back in 2014 when there was relatively little sell side analyst coverage. Now, so this again highlights the benefit of the rules based strategy we are following in MeritorQ, where again lesser known and relatively unknown companies, right, can make it into the portfolio if they deserve to be there, and to the extent they have cleared all our filtering and selection steps. And again, the strategy is not swayed by the information availability or popular opinions, right? And so again, that's the part on the information availability for how it affects MeritorQ. Now coming to another small but I think a very important point also is if you look at the information availability, right? One scenario where information availability is probably as evident is during IPO listings, right? So near IPO listings, you would find a lot of these, companies which are going to list. They, obviously go and talk to the media. They'll go and do road shows, whatnot, right? So a lot of information is generally available about a company around the time of listing, right? And generally, what you would also find nowadays is people getting WhatsApp forward from their friends, relatives, etc. This company is going to list at this price, and this is the next happening stock or the next hot stock. So then again, that's also one manifestation of information availability. You've got a lot of information about that company, and you are you're just being bombarded, just the name of that company day in and day out. The question is it relevant, right? Is it a good decision to go and buy such companies at the time of listing? What we did is we looked at again some of the large listings over the last 10 years from 2010, and that's what you see on the right side of this the right chart on the slide. And what we looked at is the 1 year returns since listing, right? And what you find there is out of the such 10 such cases, 8 cases, right, had negative returns one year since listing. Obviously, as you go away from the listing date, the fundamentals of the company, the quality of the company matters more. But just that 1 year post the listing date, when you look at these odds, right? So there's a what that tells you is 8 out of 10 companies had negative returns from the time or the price they got listed uh, and 1 year hence, right? So again, what that tells you is, again, investing in IPOs generally is not or investing in companies immediately after they list is not a good, you know, I would say investing decision as such. If you look at the past again experience, right, or what's worked in the past, what has not. Obviously, there are individual cases where this might be very different, and there could be good companies, I agree, right, which might be available during some parts of the market cycle at a relative discount. I don't disagree with that, but all I'm saying is when you look at the chance of making money from an IPO, at least 1 year, within 1 year, that doesn't seem to be the odds are not that good. So this is one of the reasons in MeritorQ we have a rule, right, where we ensure that we keep away from new listings at least within that 1 year, right? So we wait for a stock to have at least 1 year history after it got listed for it to be eligible for inclusion, right? Just to avoid this kind of a scenario, so that we are not again getting into hot stocks for no reason, and getting into again companies basis the news flow or the management commentary. Over to you.
This is pretty interesting. I did not know that this is how the information plays have occurred to our thought process and decision making. Pretty useful. So far, you told us about the positives of a systematic approach, of a quant approach. Can you also help us understand what could be the risks associated with such an approach, or what are the shortcomings of this approach?
Yeah, so I'll just take the help of this slide, right? So there are basically two broad weaknesses. One is quant or rules-based approaches. They are overly dependent on past relationships. Like I said, right, you're looking at historical data, and history again, like they say, right, it rhymes but seldom repeats exactly, right? Um, Secondly, like I said, right, so there is because once the rules are framed, the flexibility is less versus a human fund manager taking the calls. So, for example, if there is a shift in the market regime or shift in the sector leadership, for example, right? So when you think about Indian markets, right, 98 to 2000 was largely driven by tech stocks. 2000 to 2003 to 2008, largely infrastructure, real estate. And then from 2008, again, consumer and financials have done really well, right? In fact, in the weightage of consumer and financial sector, even among Nifty 50 or even the broad benchmarks, that has grown from 21% in 2008 to around 53% plus in 2020 at least. So again, these are the two broad areas where again quant strategies are slightly would find it difficult because they can't adapt quickly, and because they are created basis past relationships, right? Now what we have done in MeritorQ again is to make sure that there are two things we are doing all the time, right? One is we are refreshing this portfolio, remember, basis the rules every once in 6 months, right? So, and again, because we are looking at things, for example, like valuation, we are looking at governance, we are looking at the fundamentals of the company. So even if there is a shift in the market regime or in the sector leadership, we believe the strategy is dynamic enough to pick up the changes quickly, right? And for the point which I made on the overtly dependent on past relationship, remember that we have said it all along that in MeritorQ, it is the rules are from our insights, right? And it's based on economic intuition. It should be completely be justified basis what we think is a reasonable and what has worked or not worked in the past and what we think will work in the future, right? So again, this is human insight into design of the rules, right? And there is human oversight, and the testing of the rules, validation of these rules, how we go about doing it. Again, it's controlled by us human beings. uh, and but once those rules are decided, it's the implementation and even uh, the regular rebalancing and the creation of new portfolios is handled by the process and the system itself, right? So again, combination of human insight as well as the machine, right? So we get the benefit of the keeping the biases away, the discipline and the width of the investment universe, the breadth which we talked about using the machine, but the insight, right, and adaptiveness from the human involvement in designing the rules, right? So we get the best of both. So again, yeah, so the weaknesses are there, but in MeritorQ, we have done our best to address these weaknesses.
Okay, got it. Yeah. So one specific question on Meritor's strategy that previously we had 6 monthly rebalancing, and now we have shifted to quarterly rebalancing. So can you quickly touch upon why we have done this and how does it benefit the portfolio as a whole?
Yeah, so we made this change in the first week of January this year, and the first quarterly rebalancing was done on January 1st. So there were three reasons for shift to this quarterly rebalancing schedule. Uh, Firstly, what we felt was earlier we were picking stocks just twice in a year basis valuation. But now if you think about it, there is no reason, right, why we should pick stocks only twice in a year. Why not pick it up more regularly, right? In that sense, uh, your valuation timing risk, right, or the time you're picking up undervalued stocks, or it's not as sensitive to when you're picking it up, right? So in that sense, your valuation timing risk reduces with quarterly rebalancing versus semi-annual rebalancing. The other thing is, even things like, for example, the governance check we do, and also, in terms of, making sure that the portfolio is not overtly concentrated. This change in the quarterly rebalancing schedule allows you to reflect, or remove companies, for example, where we see a corporate governance risk which was not there 3 months ago more frequently, right? So in turn that you don't have to keep these companies in the portfolio and intervene more frequently in the portfolio. Thirdly, like I said, on the portfolio concentration, what we also found was last year with semi-annual rebalancing, one or two stocks, they were dominating the portfolio in terms of the allocation. So now what we have done is, with this change to the quarterly rebalancing schedule, now you can uh, have a better handle on that, and we make sure that no one stock has more than 15% allocation in the overall portfolio allocation, right? So again, both these changes, were done, again, from January 1st. And just to maybe address one aspect there, which is on the turnover, right? So the biggest question I think investors or people who are listening to this call will have is, if you change your rebalancing to from semi-annual to quarterly, does your churn go up, right? Yes, it does, right? So that was one of the considerations for us. In fact, the churn does go up by around 5 percentage points roughly. So earlier the churn would have been around 50 or 50 to 55 percentage points. Now it is around around 68%, which is what you see here, right? Sorry, earlier it was around 55 to 60. Now it is around 68 percentage average turnover, and we are talking about average one-way turnover. Uh, uh, but when you compare the benefit, the three benefits which I talked about in the previous slide versus this increase in turnover, you're still left with a better return even after including the taxes, right? The tax impact because of this frequent churn, right? And the average holding period for any stock in the portfolios continues to be around 1.5 to 2 years. This is the average holding period. Remember, around 30% of the stocks spend more than 3 to 4 years, and there will be some stocks, obviously, because of deteriorating fundamentals, which might be even be removed in within a year, right? But in terms of the overall portfolio characteristics, like you see on this slide, 35 to 45 stocks, so that hasn't changed. Um, 40 to 70% allocation to small and mid caps, and in terms of the portfolio concentration, now it's much less concentrated than what it was earlier, right? And in terms of the sector allocations, the we given the portfolio construct, we tend to favor cash flow generating businesses, profitable businesses, efficient businesses, with which can consistently grow their the free cash flows going forward and generate return on capital excess of the cost of capital. So when you look at some of the sectors, consumer sectors, consumer staples, discretionary, or chemicals. So materials is basically chemicals and pharma, and IT and healthcare, right? So this would be the top 4 or 5 sectors, and all of this generally in India tend to be some of the most profitable sectors, right? They have some of the most profitable, well-run companies. So again, that's the sector composition. This is again from the model portfolio. Now, when you look at the actual portfolio, how it looks like after the rebalance on January 1st, we have just compared, the portfolio before and after rebalance. That is your second column versus your first column, and then also compared it with respect to the broad universe equal weighted, which is your BSE 500 equal weighted universe. So broadly in this rebalance, or the most recent rebalance, we had 7 entries and 4 exits, and the portfolio has around 41 stocks now versus 38 before the rebalance. And like you can see, ROCE and ROE, which is like the markers for the profitability of the stocks in the portfolio, the weighted average numbers have hardly changed. And when you look at the valuation of the portfolio or the portfolio stocks as such, earnings yield and free cash flow yield are also broadly comparable. So, and moving on to the sector distribution, again, when you compare it for the new portfolio versus the earlier one, the weightage to financials has gone up. So we have two additions of 2 banks which we have added in the portfolio in the last rebalance, IndusInd and HDFC Bank. IT continues to dominate the portfolio. When I say IT, information technology companies, they continue to dominate the portfolio along with consumer companies, as talked about in the previous slide. But also remember that IT and BFSI underperformed the broader benchmarks last year, right? And because they have underperformed, what has happened is their weightage has actually improved in the portfolio. And also, when you think about materials, that's basically, like I said, a couple of cement companies, which we had in the portfolio. Specialty chemicals companies are still there, but a couple of cement companies which we had in the portfolio which have exited, obviously reflecting valuations and fundamentals. In terms of, the allocation towards market size segments or market cap, large cap, small and or mid, large cap allocation continues to inch upwards, reflecting the way the aggregate valuations have moved in the last year. Nifty was up around 20% last year. This I'm talking about calendar year 2023 versus 40% plus for large and mid and small cap indices. And obviously, due to the contrarian nature of our rules, where we are looking at undervalued companies, remember, what has happened is, there is a higher chance of now selecting companies from the large cap segment versus the small and mid cap segment, and it's kind of reflected in our our portfolio allocations also, where you can see that after the rebalancing, the portfolio allocation towards small caps has is now increased to to large caps has increased to 33%, and to small caps it's now decreased to 44% from 50%, right? So almost a 7% increase in your large cap allocation, and which is now which is basically at the expense of your the small cap allocation. The small cap is going down and large cap is going up.
Right. So this brings me to my next question. Actually, you have partially answered this question already. So last 1 year returns have been terrific in the small and mid cap segment. Uh, but we can clearly see irrational exuberance in some of the pockets. And there was a report from SEBI as well a couple of weeks back, being concerned on the excessive movements in the mid and small cap segment. So, are you thinking of reducing further allocation from the small and mid, and going towards large, or do you have any other tools like sitting on cash or maybe doing some kind of hedging in case there's an unexpected drawdown into the markets?
Yeah, I think look, I already answered this because the rules themselves have the aspect of valuation. So we are constantly looking for undervalued companies at every rebalance. So if for example one segment of the market, in this case mid and small cap, they have run up significantly, obviously you'll have higher chance of selecting more large caps into your portfolio, which is what we see, right? And also remember that the position sizing in MeritorQ is done basis valuation, right? So the cheaper the stock is, higher allocation it has in the final portfolio. So to that extent, for example, you have a large cap company making it the portfolio, and it's much more relatively undervalued versus a mid and small cap company. It will get a higher allocation in the portfolio. This is also one of the reasons why you see a trend where over the last 1 year since we launched this portfolio. So this portfolio was launched in October 2022. And if I remember correctly, our allocation towards mid and small caps when we launched in October 2022 was 65%, right? 65%, right? And we were questioned by many investors on whether this is a mid and small cap strategy then. But again, because mid and small caps have done so well over the last 1 year, 1.5 years, constantly the allocation towards mid and small cap has come down till date. And so like I said in the last slide, this mid and small cap allocation has now, the small cap allocation at least has now reached 44%, right? Whereas the large cap allocation has gone up from 15% to 33% over this period since inception, right? So the portfolio construct as such ensures that we are not we are kind of protected from this risk if at all a drawdown has to happen in this small mid cap space. But remember that we are not this is a long only portfolio. We have repeated this in the past. We don't employ derivatives or any other instruments, so we don't hedge or don't employ any kind of hedging here. Uh, and we also don't take any cash calls today, right? So this is a fully invested long only portfolio. And let me also emphasize one more point, right, which I think we have talked about in the past. This strategy, because it has we are looking at fundamentals, remember, and we're ensuring, because of the screening steps, we are ensuring that we are not getting into risky businesses at all. We are avoiding those in the very first place, right? Our screening steps themselves ensure that we are avoiding all the risky businesses in the first place. So there is a base minimum level of quality as such in this portfolio, right? So if there is a drawdown, right, even if there is, right, I believe at least even the small and mid caps we have today in the portfolio, they are much better placed than other small and mid caps out there generally in the market, and hence they should be able to weather the drawdown much better as such.
Got it. So one final question, which is again related to the sector allocations that we have in the portfolio. So does our strategy cover? So you talked about momentum to a certain extent, but does our strategy cover the latest trends in the market? So, for example, renewable energy or say defense. Uh, do you have any views on that, or because this is the common question across we get from investors that do you have any exposure to these kind of sectors which are doing well currently?
Yeah. So look, I mean, it's not again I don't think it would be right to say that these are hot sectors or anything. I think there is a lot of interest for right reasons. In the sense that, for example, when you think about renewable energy, obviously people are looking at the energy demand in India, and they are also looking at the opportunities, right, in terms of investment, and all the different things that the government is doing in terms of facilitating those investments, subsidies, whatnot. So there is a good reason to believe that there is some of these investments, or some of these companies who are in this area should do really well in the future. But in again, there are strategies, obviously, which you can obviously uh, invest to take get the benefit of that. But MeritorQ is not that, right? And the simple reason is again, like I said, right, we are here looking at companies which have at least a decent track record, right? But if you are a business, for example, a renewable energy business, or maybe a EV business, right, an electric vehicle business, you will definitely be, right now I can tell you, most of such businesses will be in the investment phase, right? So essentially you have negative free cash flows. You're most likely taken a lot of debt to finance the capex, right, whatnot. So it might look, such companies are actually uninvestable from MeritorQ's perspective, right? But that's because, simply because of our rules, where we at least require a minimum track record of governance. We require a minimum track record of, companies generating, healthy free cash flows, and having a consistent, and a growing, revenue and fundamentals, right? If we don't see that, we don't invest, right? So again, it's again nothing to do with a theme as such. We are not discriminating against any theme, and in future it can happen always, right? That whenever such businesses in these areas, they reach a level of maturity, right? Whoever is the winner in this area, they reach a level of maturity where they have a good track record, and they go through all these steps, they will make it into the portfolio. So all I'm saying is, given where we are today, all these businesses are today, maybe there's a lesser chance they would be in MeritorQ. But in future, like I said, right, we never know. But we also don't discriminate against any of such businesses or these themes.
All right, thanks. Yeah, this was useful. I think it has something to do with our biases, probably the recency bias or the information availability bias, and that's why we
I won't
keep
say I
getting
don't say
it.
this is a bias, Alok. So again, that's why I disclaim my
No,
statement
no,
that.
for me, or for the investor, because we keep hearing these sectors are doing well on a daily basis. We tend to believe that, okay, these are the sectors where we need to be. Okay, so thanks, Krishnan. I do not have any further questions. If you have any closing comments, please share. We are good to close this session.
Sure. So thank you again. Thanks a lot to everyone to who dialed into this session and listened to us patiently. Um, like Alok said, this has been close to 18 months. This portfolio has been live, and I think we have been live on small case now for nearly a year. So yeah, I mean, and we have, like I said, right, our investment philosophy, and what we said today is completely transparent. And you know, if you think of subscribing to this portfolio, please go ahead and look at the details. It's available on small case. So yeah.
Thanks, Krishnan. If anybody has any questions, you can drop us a line on help.ia@marcellus.in. We'll be more than happy to share all the relevant details. Thank you everyone for attending this session. We are good to close now. Have a great Sunday. Thank you, Krishnan. Thank you, everyone.